You used to be a trader on the trading floor. Tell us about this time in your life. Tell us about what it was like back in the day.
Yeah, I mean, it's such a long memory. I started on the floor of the Chicago Board of Trade as a clerk in 1997. And at that time, it was still open outcry. Like you're 6 bid at seven or a quarter bid at a half in the grain room. And technology was just starting to integrate into the pit in the form of like handheld devices. And within 3 years, everything really started fast tracking to HFT algorithmic, when the machines hooked up to the exchange. And for the first like couple of years, there was a lot of activity, your seat lease, there was value in being able to see the order flow in the pit as a local. And then that kind of went away when the screens came in and the machines connected. So it was literally like being a dinosaur and seeing the meteor hit. And the local floor traders basically went the way of the dinosaur. Um, Maybe I was lucky to be younger and just not having a ton of success trading in that time period. And I left the floor in 2002 um, to embark on who knew at the time would be a career in financial services, in capital markets. Um, I always say jokingly, if Uber had been around in 2002 when I left the floor, I would have been driving Uber, trying to figure out, what my next move would be, because I really didn't understand the value of what I learned being a trader in what felt like the bowels of capitalism. I mean, it was up, down, sideways. You were there to make money and manage risk in one of the riskiest environments in the world. So you became good at managing risk, or you were gone, and it was more and more difficult to manage the risk. I'm not a quant or an algo like computer programmer, so when I left the floor, it didn't dawn on me that I could become a quant algo like prop trader. I left the floor looking for something to do, and it took me about 6 months to realize like what the true value of what I learned on the floor was, and then I kind of dove back into financial services, like off of the floor.
Yeah, that's interesting. I always love hearing the stories about how the energy was in the floor, the trading floor, right? All the things that were happening, uh, just different dynamics. I'm just curious. You mentioned obviously a lot changed with technology. Was it a abrupt change, or was it like a gradual transition from when you saw the kind of
So
integration there?
if it's possible, both, right? The abruptness didn't happen on the Chicago exchanges as much as it did throughout the globe, and then Chicago had to catch up. So you take like the London Futures Exchange, the Life Exchange, within a week when they went electronic, the wealthiest cab drivers in the world were in London because they were the former floor traders. It was gone in a week. As soon as they went electronic, nobody fought it. They just adopted and got out.
Wow.
There were remnants of, I mean, there's still a couple pits in Chicago as we speak. The open outcry, the SIBO has the SPX and VIX and OEX that still trade in an open outcry setting. The box exchange just opened a floor, and they have an options exchange here in Chicago. The Boston Options Exchange in Chicago, which I get a kick out of. Um, they still have a trading floor as well with 40, 60 traders. So there was a lot of abruptness across you know the globe, but Chicago somehow managed to stave off all of it. And the euro dollar options still trade in the pit too. um so there are remnants of it. It's sad to see, being going back on the floor. I get down there occasionally, and it brings tears to your eyes because you're like, wow, when I, first was in this room and there were thousands of people taking risk and yelling and screaming. And when it was slow, you set gum traps and you shark finned people. Like there was nothing like it. To see it go it was sad, but it was necessary. You take life lessons. You can reminisce on it, or, figure out what the next move is. And, a lot of people did figure that out, and continue trading electronically. I didn't. I couldn't figure that out. So, I entered more into traditional finance.
Yeah. Love it. Well, tell us, so tell us a little bit about Regiment Securities. I guess take us back, to the start, and tell us a little bit about what you guys do.
Yeah, it's really, Regiment Securities is kind of like a culmination of my 30 years of experience on, in the capital markets, between being the floor trader, managing my own money, to being a buy side asset manager, to then becoming a pure sell side advisor. And, that culmination of being on all the sides of the market in the past, from like 1997 to 2020, that 23-year period, basically learning all of the nuances of the business. When COVID hit, I just saw an opportunity to basically say, there's going to be a lot of disruption from this COVID lockdown, disruption across the board. And, what I went back to in my mind is, I'm like, wow, I remember when the airlines shut down after September 11th in 2001. And I think they were down for like 3 days, 3 full days. So that's 3 full days of non-operating. There's no money, no tickets being purchased. And what we learned is businesses don't have a lot of free cash to just not produce income and still pay all their employees and all their vendors. And a lot of those companies needed government assistance. I think all but one, Southwest, got some kind of subsidies. So I heard Governor Pritzker announce we're shutting everything down. And I thought, well, it's not going to just be the airlines this time, right? It's going to be the airlines included with every single other business. And we just did some quick back and napkin type research saying, how many businesses do we think have 90-day of cash reserves where they can afford to pay all of their obligations while they're not doing any business? And that number was very small. Probably 1% of businesses have 90 days of cash reserves where if they lost all of their customers and paid all their employees, they could still make it. So we knew at that point there were going to be a lot of disruption. There's going to be a lot of problems created from the lockdown. And those problems usually come in the form of automation in some form, fashion, and technology, and new solutions to these new problems. New solutions to new problems pose challenges to the capital markets because underwriting parameters are based on, this is how we've done these types of deals before. And when you don't have the data and research to back up how you're underwriting deals, like new creative solutions for funding companies were going to come about. So that was really the impetus and catalyst. Was the COVID lockdown triggered the idea of like, let's start a boutique investment bank that's going to cater to these problems that are going to be solved in the next 5 to 10 years. So we're just coming into what I think is the peak season to get funding to these companies that are solving and have solved all of the problems caused by the COVID lockdown. To give a couple of like real examples, you see a lot of AI, edge computing, there's energy issues, but, data centers are a good example of, a new solution to what the problems caused by the lockdown are. Automation with AI in these data centers using, the new waves of GPU chips is a huge opportunity. You look across commercial real estate and different industrials, and valuations have come in. Data centers keep ripping and roaring. So we were lucky enough to, make some relationships with some data center developers and partnered with a couple other groups that service data centers to lock in some relationships where we thought there would be growth. And that's just one example.
Very cool. So you guys saw the opportunity with COVID where, things in the way that we do things is kind of going to change. And you saw that as an opportunity to kind of start Regiment. Is that?
Yeah, it was like the light bulb, like every light bulb in my head went off saying, this is the opportunity of a lifetime.
Yeah.
Everybody was like Chicken Little, like the world is ending, save your cash. The oil market went negative. Like people were getting paid to store oil. Like it was nuts. And literally everybody's scared, the world is ending. And I'm like, well, let's say the world ends tomorrow. We're all end, like all of our money, all of our investments, our opportunities, like it's worth nothing. So why don't you take some educated bets, don't go all in on one thing, but take some educated bets on what you think is going to be the next big thing, and then follow it. Allocate $25,000 or $100,000 or whatever your, minimum investment unit is to 10 to 15 different areas that you think there's going to be growth from this lockdown, and then follow them. And the ones that start doing better, double down on the ones that are coming out, aces. And that's kind of what we did. And it took us from the time of the lockdown until we got our registration with FINRA for the broker dealer. It took about a year. So we got approved. We're like a week away from our actual 3rd year anniversary of Regiment Securities. So we got the broker dealer approval in July of 2020.
Congratulations.
So we're starting our 4th year here. Yep.
That's always a journey from the broker dealer perspective, as you know, right?
Yeah.
Process.
A lot of brain damage.
Yes.
Serious brain damage.
Absolutely. I'm curious, Mike, just with the process you've gone through and obviously kind of where you guys are at today, made some interesting calculated bets early on, which is amazing. How has that changed? Maybe obviously some things have gone really well. Has your outlook changed on certain trends? Given you're 3 years in now, you made some initial thoughts into.
It's funny because it seems like market cycles. Like I'm used to like what we would call like slow market cycles, which some would even deem fast, but like 7 to 10 year shifts in sentiment and trends is kind of what I grew up with. Like from the late 90s with, all this stuff going on with long-term capital was like a big event in the late 90s. And that kind of showed Wall Street how a government bailout would look. And then, that gave Wall Street the idea of like, hey, let's lever up. The New York Fed just failed out of what looked like a catastrophic financial event. And that was really the catalyst in the next 10 years, right? The Wall Street banks levered up. They used Louis Ranieri's formula of the mortgage-backed security, and off we went. And, that 10-year period from 98 to 2008 shifted overnight when, Bear Stearns, the 2 real estate funds, mortgage-backed funds kind of failed in 07. So you started to shift there. The market cycles today, they're happening 100 times faster. So right when you think like, hey, now's the time to do, you're like, what just happened? And you look at the period from March of 2020 when we had the lockdown, right? You had a huge dip in the stock market, the fastest drop in the stock market in history in March of 2020, right? Followed by the largest, longest rally in the stock market history. And in the meantime, you've had 2 wars, geopolitical unrest across every nation, huge spikes in interest rates, the 2nd largest bank failure in the history of the United States, since 2008, the largest since 2008. You've got all these things going on. Meanwhile, we just keep chugging along. So these we packed about 150 years of economic, political, societal changes into the last 4 years. So it's really hard to say anything other than like, it feels like everything that we used to know is completely disrupted, and that's good and bad, right? You kind of lose the sense of like, well, this is how we always did it. And, these are the underwriting techniques and this is how asset management should look. Like you're kind of throwing a lot of that stuff out of the door. But the benefit of that is we're all starting with the same data sets and base points. So as long as you still focus your immediate attention to risk management, discipline, and adaptation, those are my 3 fundamental building blocks of trading and investing. And you stick to the risk management, the discipline, and the adaptation, there's endless opportunities right now.
Yeah, I like that. Obviously, the adaptability is key for me too. That's just, it seems like a constant. It has to happen for everybody, right? The discipline.
Yeah.
Achieve whatever you need to achieve. So that's great. Appreciate you sharing that.
Let's dive into some of the businesses that you guys work on, Mike. So you mentioned investment banking. You want to give us just like kind of a high level scope of maybe some of the type of companies you guys work with, some of the kind of company you guys invest in?
Yeah. So from an investment perspective, We have made balance sheet investments in about 10 companies. We're not allocating right now. We're kind of watching and following the companies that we did invest in to see if we can get some liquidity, and then we'll start allocating again. We made investments in 2 venture capital funds as LPs, just straight up LPs. We're paying our 2 and 20. And the idea there was to create a network of other, like-minded investors, meet the other LPs in the funds, see some deal flow for the broker dealer. So it was strategic, making LP investments into the 2 venture funds. And then our first round of investments, we focused on fintech, like early stage fintech startups, but not just to be like the venture capital asset manager where we're like, all right, we're going to invest in 10, 9 of them are going to fail, 1 of them will succeed, and we'll return a 21% IRR. Like, we're not looking at it like that at all. What we're doing is we're investing in early stage, or we invested in early stage companies that have technology that we actually can use for our business, or we can add a ton of value with our other portfolio companies to make them more profitable and then to make us money in at the same time. We're tending to see like overlap in what we call fintech into like real world assets. So the intersection of where fintech meets real estate, or where fintech meets, you name it, a grocery store. Like, what's processing the payments in a grocery store? How are they paying their employees? Like, we've leveraged our relationships in the fintech investment world from our holding company to make those relationships. And now that we have those relationships, we've got a story that has been unfolding for 3 years with relationships where, when we invested in XYZ company, they were doing 5 million in revenue, not breaking even. We helped them get their, seed capital. Now they're doing $20 million with 4 million in EBITDA, growing quickly. And there's opportunity for us to leverage, not just like through the other portfolio companies, but through our leveraged networks with our other investment bankers. So what we try to do is get not just like a capital raising agreement in place with our larger clients, but also like a commercial agreement that if we're able to bring them customers, that will drive the value of their business up, but also to get like commission sharing agreements and revenue sharing agreements with those companies where it's not securities business, but we'll get paid if we're able to get them business, new customers, new clients. So we're actively trying. My formula for it is like, if you just give a company funding, you're not really helping them. That's about 33% of it, right? There's funding, there's your experience, or what I call mentorship, and then there's connectivity. And if you rank each one of those, like 1 through 3, like the best investor, I think, in a company is a 9, right? They fund, they've got unbelievable experience, and they're willing to connect you with their network. Like, if you find that type of investor, like, that's what you want. So that's what we try to be with the companies that we've invested in and that we work with. And then it's just, if we ever change the name of Regiment Securities, it would just be called Connecting Nines, right? You want to look for those other 9s and those other businesses and those other relationships and just lean into those. So it's a selective process. But a lot of people don't think of it that way, right? They think of it like, hey, I'm going to get on Shark Tank, get a bunch of money, right? And that's really only that on a 3-legged stool, that's just one leg. And you need all 3 to really lean in. And that's what we, continually trying to position and build here with Regiment.
That's great. That's a unique position, kind of how you outline, how you approach it. Obviously, you're looking for actual applied use cases to technology that you guys can use, and also your underlying portfolio companies, which I think is unique, right, for most how they look about investing from an M&A point of view, or just investing in general. So it's interesting. Very cool.
Yeah, I don't know if it's unique. I know other companies that have done it. It's like just what works. The venture capital to me with the like as an asset class, it's hard for me to absorb it in my head. where you invest in 100 companies, 99 fail, one makes it, and you're returning 20%. Like that to me isn't sexy. Like finding the right team in the right market and being able to lean in with a big customer and then helping them like connect with other people in your network. It's kind of like a mixture of investment banking, merchant banking, private equity, and venture capital all wrapped into one, right?
Yeah, that makes sense. Much more value add than just providing the capital aspect, like you said. I like that a lot. Where does the name Regiment Securities come from?
That's a great question. And, I was not in the military. People always ask, thank you for your service. And I'm like, no, it's not a military name. Before Regiment, I started a one-person advisory company called FinTech Ranger. And I picked Ranger because that was my, I think I have a picture of it here. You can see the FinTech Ranger. My high school basketball team, we were the Rangers. That was our mascot. And when I started my one-person advisory, my attorney said, you got to name your company when you file the LLC. And I'm like, I'm not any good at this stuff. And he's like, all right, let's just call it FinTech. I'm like, well, you can't just call a company FinTech. That wouldn't make any sense. Like FinTech LLC, that's kind of ridiculous. He's like, well, FinTech, call me when you think of something that you've had success at FinTech something. Call it FinTech something. So I'm like, Ranger, FinTech Ranger. So it had a ring to it. And then I put this like Calendly link in my email and like jokingly to brand it, I said, book a meeting with the Ranger. And it just kind of stuck. Like all of a sudden I was walking, at a conference and they're like, the Ranger's here. Hey, Ranger. Like, so it just kind of, and I loved it because, that was what we were known as in high school, or the Rangers. So, we went with it. It stuck. And then that was in 2017 when I started FinTech Ranger, and then it started ramping up, and then we started Regiment. And we picked the name Regiment. One of my investors and I went to lunch, and I'm like telling him hey, I think we should ramp this advisory into an investment bank, and we should not just focus on FinTech, but other verticals. And he's like, hey, Siri, what do you call a group of Rangers? And Siri was like, a regiment. And I'm like, there we go. I'm like, I actually like the sound of that. Like a group of Rangers is a regiment. So it's not military, and it's a fun story, but that's the background behind it.
Very cool. Very cool. Yeah, I like that. Just right off, building off the high school.
Yeah.
My network is well for the Bulldogs.
They were our high school mascot. We lived right on the outskirts of the Nicolet National Forest up in northeastern Wisconsin. So we were forest rangers.
That's funny. Yeah, we were actually the Bulldogs actually in my side. So
nice. Yeah. There was an actual ranger station right downtown in the town I grew up in. So
it's very cool. That's awesome. Well, I'm curious, as you kind of have looked at the market today, what are some interesting trends you're seeing in the marketplace, given kind of where you're sitting in your lens?
Yeah, I mean, the most interesting trend, right, is the stock market just keeps going higher. I haven't looked at it yet today, but last time I looked, we were close to 5,600 on the S&P. That's interesting because interest rates have gone up. So that relationship between the stock market going higher and interest rates still being high is the most curious trend. And what we see are a lot of investors looking for double-digit yield in their investment portfolios, and a lot of those investments are coming in the private markets. So the private markets had tailwinds going into COVID, and they just keep getting stronger and stronger. Like people are scrambling to help develop the private markets to look more like the public markets, where you can log into your E-Trade account or your Robinhood account, click on a button, buy a stock, change your mind, sell it, wire the money out. Like that level of liquidity and transparency in the public markets, you can see this unfolding daily, that type of liquidity and transparency is desired in the secondary private markets, and it's coming fast in big droves. Like yesterday, just to back that statement, I think it was Bloomberg bought Preqin or BlackRock, one of the two. It was a B.
Bloomberg, yeah, I saw that.
One of the Bs bought Preqin for like $3 billion,
BlackRock.
and they're
BlackRock, yeah.
a premier, you know, alts data investing company. So that trend, higher interest rates in the private markets, you know, double-digit yields on secured and non-secured deals, private credit, business development corporations, they're pumping yields out to the investors. So if you're an investor, you know, your 100-year historical annual return in the stock market is 7%, right? If you can get into a private credit fund that's paying a 12% dividend and they're doing all deals that are senior secured debt, like you're a swear word. I won't say the swear word.
It's a no-brainer.
If you don't take that investment, like you're locking in almost 2x the historical stock market return with less volatility, less risk.
I definitely want to talk private credit. Let's talk more about the private markets, because you're saying how they're converging kind of similar to the traditional equity markets that we see, the public markets. Better word for it. But talk to us a little bit about that. What are you seeing on that front? Are we getting to a point where, you know, obviously larger companies like SpaceX, you know, secondaries are pretty liquid, from what I understand. But are we getting to the point where like some of these smaller companies are able to get, you know, pretty liquid as well?
Yeah, I mean, you're really starting to see those trends, and the disruption comes from, regulation. So if you look at the heydays of the IPOs, right, the 80s and the 90s, you have a big company, a tier one bank that has asset management, wealth management, and investment banking. Well, if you've got 1 million investors that have a wealth management relationship with your investment bank, your distribution's built in, right? You just go to your wealth management team and you say, hey, I got a $100 million IPO, and just shoot it down the wealth manager's desk, and you raise all that money through your high net worth wealth management people. That was the heydays, right? All the regulation that's come out, like the big banks aren't doing that anymore. That distribution channel for the IPO market is gone. There's like Chinese walls, and they're just not willing to take the risk anymore from a compliance and regulatory aspect. And then you had major changes to the 1933 and 34 SEC Acts in 2011 and 2012. And they say history never repeats itself, but it often rhymes. Like almost to the day that the Great Depression happened, and then the regulatory reform in 33 and 34 came out, and then the Investment Advisors Act of 1940, right, followed it up 6 years after that. If you look back to the regulatory reform that came out of 2008, like almost to the day, you had the Dodd-Frank and then the Jobs Act, like 33, 34. So what the Jobs Act did is loosened up private markets for both accredited and non-accredited investors, and they're continuing to get looser. The like Reg A plus, like the Reg A plus, being able to raise $75 million from a blend of accredited and non-accredited investors is amazing. That didn't exist before 2012, and nobody was really leveraging it, but now it's being leveraged, right? People are filling these $75 million like capital raises in the private markets. Well, if you invest in a $75 million Series A or Reg A plus, you're going to want to see where that investment, like how it performs. So you're seeing these technology tools come in to provide that liquidity and transparency in the secondary markets. Like how the secondary market works in a private transaction typically was whoever raised the money, whether it was a real estate or, a direct issuer into a company, you're like, hey, I need to get my money out. I know that it's illiquid. I know I signed the PPM that said it could take 10 years and I could lose all my money, but I really want my money back because I want to buy a boat. I want out. Well, then the issuer would have to call on other investors saying, hey, I've got and then you have to get a discount to it, probably 30-40% discount to where you got it. And it's just a messy scenario. We're seeing technology platforms come in that are basically starting to make markets in secondaries for the issuers where there's a constant in and out. And that is going to continue to evolve. And, you're going to see a reversion back to IPOs, through the exchanges, whatever those exchanges look like in the future. the big ones in the U.S. right now are NASDAQ and NYSE, NYSE ICE. They could continue to be the market leaders if they're in the seat to drive the technology and the adaptation for the secondary markets. But you're seeing an increase of regulatory filings for both broker-dealers for the first time in like 25 years, right? There's an increase in ATSs, automated trading systems, DCMs in the futures market, designated contract marketplaces. You're seeing an influx of those because that's what the more mature companies are realizing. Hey, we don't like being regulated, but we see it as a necessary evil to basically open up this part of the capital markets in the private place. And you're seeing that day by day, more and more.
Yeah, that's the exciting part about it, right? The private market's kind of opening up. You mentioned obviously the crowdfunding platforms are being more robust with their technology and technology in general. The digitalization of the process for secondaries, right? Obviously the promise of liquidity and all that, moving to more of a mutual fund environment, like you said, daily transparency.
Yeah.
Now moving to more of a T+1 environment, or even on T in certain cases. Pretty amazing.
Yep. T+0, that's where everybody, the ability to get to there. And, there's definitely progress being made there. It's super exciting, and the great thing about the capital markets fintech is, a lot of times in like early stage startups, like they have that first to market fallacy is what I call it. First to market may be in other markets, but financial services, financial technology is so fragmented. You don't have to be the first to market. So what I always say is if you take your time to do it right and don't go super fast to be first to market, but be in the market with the first group and really grow, right? Because financial services is so fragmented, you don't have to be the first to market. You should do it the right way and get to the market in the first, 25 to 50 companies that are addressing an issue. And, the top 10 of those usually do pretty well. Like when you look at, like when I first left the floor and really started understanding how financial technology works, I got to watch and learn from a company called Options Express, right? They weren't the only online equity option brokerage house, right? There were a couple dozen of them that were grabbing market share and doing well. Like Thinkorswim, they had a great exit. There was a firm in San Francisco called Zeco, Options House, Options Monster, Options this, Options that. There were dozens of these, and they all, not all of them, but a good chunk of them had solid exit. Options Express happened to be the largest of all the exits of the online equity brokers. But really, I learned a huge lesson there that, hey, you don't have to be first. You got to be really, really good and in that group that does things right. And, people, the bigger firms will want that integrated into their current offerings. So definitely the private market play here is like the equity options of the early 2000s.
Yeah, I had an interesting conversation with someone recently about this. At least great insight, just being part of the game, right? Being in it wherever you're at. I was talking to you.
Yeah. Even if you're on the bench and you get tapped to be the pinch hitter and you get hit by the pitch, you're still in the game. You still get the ring when you win the World Series.
A friend of mine, he's in NASCAR. He's like, I like to be the draft, the first car, right? At least be part of it. And then I can hopefully swoop around and meet him before the finish line. That's kind of the idea, right?
That's right.
No, it's very, very interesting insight there.
Cool. Mike, talk to us about the private credit and the real estate side of your business. What are you guys looking at over there?
Yeah. So, we run across all types of deals. And right now we're just seeing a lot of activity in the private credit market. And a lot of that is just from yield, right? And the ability that private credit can put money out quicker than a bank. They don't have the same regulatory confines as a federal bank or even a local regional bank. So they can move quicker. And if you need money, like quick money, private credit seems to be like the number one place to go. If you're an investor, private credit makes a ton of sense because you're getting double-digit returns. A good credit manager, is paying 10, 12, 14% to their investors. So the investor is getting, like, think if you're a venture capitalist and you're sitting on all this money. So you want to do diligence? Do you want to go raise money, all this, or put your money in something that's paying 12% and you don't have to do any of the work? You don't have to diligence anything. It's a pretty interesting scenario where, these private credit funds are putting money out in the high teens, low 20s with equity kickers, warrants, you name it. And, they're returning upwards of 25, 29% IRR in some cases to the investors with a stable yield. So it's definitely still white hot. I think it's going to continue for, I don't know how long. I thought we'd start seeing some signs of banks starting to lend right about now. We could see some action, but like, it's still kind of geared around private credit with being able to move quickly, nimbly. And, the investors that invest in these funds are getting their returns. So until that doesn't work, they're going to keep doing it. And I'm not in the business of predicting market cycle turnarounds and anything, but this one looks pretty strong right now.
Yeah. How do these returns compare to, maybe a decade ago?
Well, a decade ago, there was no interest, right?
Right.
We spent the last 15 or 14 of the last 15 years in a zero interest rate environment coming out of 2008. So if you could get 2.5% on your money, that was like a huge victory. Like, money markets didn't exist. Like, people were trying to attract you with like 0.1%. We'll pay you 0.1% in our money market, for 14 years. Now, all of a sudden, you're seeing these double-digit returns. You're seeing, the risk-free rate, the high fours, low fives, that just spurs a whole bunch of activity. And, I'll be 50 in October, and I've lived through interest rate, zero interest rate, and now back into interest rate. If you are in your late 30s, early 40s, and you've spent your entire career in financial services, capital markets, this is the first time you've lived through an interest rate positive cycle. So there's a lot of different nuances on what to do, how to invest, what to get into. Like, the banks aren't lending like they were in 2009, 2010, 2017. They've had to shift their mindsets. Silicon Valley Bank failing exposed some of the, short-term versus long-term obligations and, what they're lending out and what they're actually getting in. And I think that woke up a lot of banks, like, scared them. And you're still seeing tight money from that. And yeah, this trend could continue for a while. And then, if the Fed starts lowering interest rates, it could end like that. So kind of be on your toes.
Absolutely. Real estate markets, also something I'm curious to talk to you about. What are you guys doing in the real estate? What are you guys seeing there?
Yeah, so our real estate team does a really good job of explaining like what they do. And the thing I like how they describe it is they lead with the most difficult part of real estate is raising LP money, like equities, like the equity for a deal. Like, debt, not as tough, but getting the LP investors, the equity investors. So we lead with equity. So we work with seasoned developers across the United States, but have a pretty good concentration in the Midwest, working with developers that are building some pretty cool, back to the early part of the conversation, solutions to what our major problems are, and helping those companies by getting the equity and structured finance, like nuancing and massaging deals where it's a blend of debt and equity from one large institutional investor, or, having a smaller real estate developer that's building a student housing complex at one of the major universities where we're passing the hat to high net worth individuals that went to school there that want to, be part of the community where the university they went to school is. So interest rates obviously had a pretty large effect on the real estate environment in the past 2 years. So we've been doing a lot of recapitalization deals where we're finding institutional investors that are going to get blended returns on, what we call dequity or debt and equity, kind of in a blend, where they're going to get, mid-teens, where the developers are now starting to get to the point where their models, their financial models for these properties can support a 14, 15, 16% interest rate in their capital stack. So it's starting to loosen up on the real estate side.
Yeah, that's great. I guess from a raising capital perspective, I'm curious your thoughts, Mike, how that's kind of changed as of late, kind of where things are at and how people are getting access to capital, maybe more venture, VC based, or just curious on your thoughts there.
Yeah, the access to capital, we see a lot of like patient money, like moving away from the fund model and more institutional, like money managers that are managing pension and endowment money and family offices. That seems to be long-term patient capital. And we see the trend moving towards that versus, you're in a fund, those funds have investment periods, like when a private equity or a venture fund who's managing LP money gets into a deal and that deal starts ticking close to that time bomb on the fund, it's not good for the fund, it's not good for the investor, and it's not good for the business. So it's one trend we're starting to see in that more traditional VCPE market, are funds switching to be more evergreen. I think Sequoia made the move a couple of years ago where they announced their big fund was no longer going to be a 5 or 7 year term fund. It's going to now be evergreen. Like we're going to invest in these companies and build them, and we're not going to have a set exit based on time. Our set exit will be on value. And I agree with that 100%. Some people just get caught up too much on the time aspect of I want my money. But until you get to that hard stop on the time, you don't really understand that that's not a good relationship to have between the money and the issuer.
Absolutely.
It's a really good point. Yeah.
Yeah, that's great.
And on top of that too, the evergreen structure kind of lends itself better to secondaries, if you will.
And to your point, Mike, when you have the technology, because it's also a technology challenge too with operations when you have evergreen structure as well. But if you have new technology that can support that new model with more transparency, liquidity, and that evergreen model going forward, that's exciting too, right?
I'd love to hear your best. I know you do some good impersonations. Love to hear your one of your favorite impersonations that you can do.
Yeah, it's funny, but it was my daughter's birthday last night. She's 15.
Happy birthday!
And yeah, and right at the end of the night, she's like, "Dad, this is my dad. He does impersonations." So, like for kids, I always do Donald Duck. And my wife runs a summer camp, so on Fridays, each Friday, I'll help cook the hot dogs and do Donald Duck, and the kids love it. So it's like, my name is Donald, and like the kids are like, "Holy crap! It sounds just like Donald Duck."
That's really cool.
Yeah, so that's a fun one. But yeah, I don't know how or why I started doing those, but I've been doing impersonations, kind of like kids' birthday parties, and at a conference where you had a couple beers, like it's always fun. It's memorable, right? They'll like remember you when you start talking like Donald Duck.
I love it. That's great. The big hit at the kids' party. That's amazing.
Yeah.
Very cool.
Hidden talent.
Yes, great insight too, Mike.
Awesome. Well, Mike, this has been a lot of fun. Really appreciate the time. Appreciate you joining us. Where could people go to connect with you and learn more about Regiment Securities?
Yeah, our website is regimentsecurities.com. Our holding company URL is regimentco.com. And that's kind of where you learn more about the whole ecosystem, not just the broker-dealer.
That's great.
Yep, that's how you get a hold of us.
Perfect. We'll make sure to include that in the show notes, Mike. This has been a great conversation.